This is a quick video summarizing the results from my market making strategy that I developed and ran live on Kalshi at very small scale for the last 2 weeks. Here's a quick summary of performance. Annualized Sharpe ratio is slightly over 10, which is extremely good. Daily win rate, a little over 70%. Max drawdown is quite low relative to cumulative realized P&L of around $50. These numbers are highly encouraging, but as you can see, largely driven by one or two really good days. And we will get into a more detailed discussion of what these numbers actually mean later in the video. Today, I want to give a quick recap of the strategy, go through the results, discuss the main takeaways and next steps. This is a summary of my strategy logic. I go further into detail on this strategy in my previous video. This is a market-making strategy that attempts to profit from time arbitrage in mutually exclusive prediction markets. This is a one-sided strategy. We are only quoting the no side. We start by resting bids for no in every actively trading market within the mutually exclusive event. Once one of our bids is hit, we then look to complete the basket by paying less than we know it would pay out for, which happens as order flow randomly moves the market between the bid and the ask price. We're effectively capturing the bid-ask spread over a set of mutually exclusive markets within the event. Once we've completed a basket, we hold a fully hedged position with locked-in profit. We bank that basket, which means we hold it until settlement, and we start the process over again. Before I continue, I want to define a few key terms that I'll reference in the rest of the video. First of all, I'm defining a banked round as a set of positions, in this case no positions, across markets within a mutually exclusive event that we have acquired at a cost such that our downside is limited. Downside is limited because of mutual exclusivity. One and only one of the markets within a mutually exclusive event will settle to yes, so we know that in the worst case scenario, one of our no positions settles worthless and all the others pay out. This strategy specifically requires each round that it banks to exceed a minimum margin. Next, I want to define what I mean by the word bonus. We bank a round of no positions. Like I said, our worst case scenario is that one of those no positions settles worthless. However, if that banked round does not include every market, every possible scenario in the mutually exclusive event, then there's a possibility that all the no positions within the round pay out. This scenario represents a bonus. So we've banked the round at a cost such that we've locked in our margin in the worst case scenario, but we have the upside bonus of one additional contract that we expected to settle worthless also paying out. We can define bonus exposure as the odds based on the market price at the moment we complete the banked round that the unheld market wins. This is a way of quantifying asymmetric upside for that round. Finally, we're relying on time arbitrage to complete these banked rounds profitably. We have some exposure between the time we entered the position and the time we complete the banked round. Namely, the position that we hold can resolve against us without being able to complete the round. This strategy relies on stacking rounds, each for a small profit, over and over again. But typically at the end of the day, we have that open exposure of the unfinished round that settles for a loss. This is a drag on performance, and I'll talk about some ideas for fixing it at the end of the video. I explained all of this in further detail in my prior video explaining the conceptual underpinnings of this strategy and my first experiment with it. I wanted to give an update on what I've done with the strategy since then. I spent about a week after the initial test I discussed in the prior video iteratively testing and debugging the strategy in a few daily high temperature markets on Kalshi until I got to the point where I was confident enough in the system to give it a longer leash. Then I deployed it for 2 weeks to 20 markets each day. Now let's see the results. This is the overall dollar value performance over those 2 weeks. The left-hand bar is from the iterative testing, and the right-hand bar is from the actual 2-week deployment. I have it split into 3 categories. Locked floor, which is the sum of each completed round-trip trade, each banked round that has successfully taken advantage of mutual exclusivity and time arbitrage and stacked a little bit of profit. Note that this is profit net of fees. On top of that, I have realized bonus, which I explained a minute ago. These are rounds that the strategy banked profitably, and then none of the legs ended up settling worthless. And then below, I have the losses from the open round unfinished at the end of the day, settling against us. So like I said, I deployed this strategy to 20 daily repeating high temperature markets on Kalshi. We can see that the realized bonus is concentrated entirely within 5 of those 20 over the 2-week period, which makes sense because this is an asymmetric tail event that we are capturing. Then we have the base profit and the unfinished round losses fairly consistent throughout all the cities, although there are some subtle differences that I will get into shortly. I looked at the impact of order book dynamics on performance. In the left-hand chart, we see a clear positive correlation between the number of trades per day for the event and the number of rounds we were able to complete. This makes intuitive sense. Markets that trade more actively allow our strategy to turn over more. This is arguably the single biggest driver of P&L for the strategy. The strategy is a market-making strategy. We're trying to stack small amounts of P&L by completing as many round-trip trades as we can throughout the day. And then on the right, I looked at the competitiveness of the order queue at or better than our price. Interestingly, there's a pretty wide variance between order book depth, queue competitiveness, and the number of trades per day between these daily high temperature markets. The largest cities like New York and Los Angeles trade an order of magnitude more volume on a given day than smaller cities like New Orleans and Las Vegas. I'm naively attributing this to the existence of a larger pool of retail traders in the more populous cities, with Chicago and Houston being major outliers having large populations but surprisingly moderate volume. Another interesting observation here is that higher total volume does not necessarily indicate a more competitive order book. These are my initial observations on this topic. I think there's a lot more research to be done on order book structure and anomalies between prediction markets that could really help sharpen this strategy and others like it. So when I went through the performance stats in the beginning, I mentioned that it was largely driven by a small number of days. Let's have a closer look at that. Although a double-digit Sharpe ratio is extremely good, I'm not reading too much into it right now for a few reasons. One reason is that this is an intraday strategy, so we expect structurally higher annualized Sharpe. The more important reason is that the sample size is small. These are live results, 20 markets per day for 14 days, so there's some level of robustness here, but most of the profits came from tail events in a small handful of markets on only 2 of the days. So it's yet to be seen if we can rely on this asymmetric upside. Right now, it's better to conclude that we cannot rely on it. However, 2 things that I think are important. Daily win rate in excess of 70% and positive base P&L excluding the tail bonuses. This tells me that my thesis behind the strategy, using time arbitrage to capture spread in mutually exclusive prediction markets, has some credibility. So we've tested the base version of this strategy for 2 weeks now, and the results show a lot of promise. Where do we go from here? I think the 2 biggest levers I can pull to improve this strategy are number 1, increasing turnover, and number 2, minimizing the number of unfinished rounds at the end of the day. The strategy has demonstrated a small but consistent edge, so increasing turnover while maintaining the edge will increase returns. The open round leak is a consistent drag, and I believe it can be mitigated. The first thing I want to test are some simple and then progressively more complex ideas for how to reduce the number of open unfinished rounds that settle against us at the end of every day. This can start with a simple time cutoff, and it can progress to dynamic cutoffs and hedging based on historical market data. Next, I want to increase turnover. Right now, the strategy rests orders at a depth below the mid price and waits for takers to come and hit them. I believe we can increase turnover by simply joining the best bid to get filled more quickly, perhaps sacrificing a little bit of margin per trade, but with the benefit of increasing volume that we trade. And then a few more improvements include attempting to reduce fees, increasing size, attempting to skew the composition of the baskets we acquire to set ourselves up for more asymmetric bonus potential, and adding in the yes side. At this point, this has been a quick and dirty approach to getting something off the ground, and it has shown promise. I'm planning to incorporate a more rigorous, academically driven approach to market making into my iterative testing approach. I'm working on this now, and I will be testing it in the coming weeks, and I plan to share the results in future videos. Stay tuned for those updates. Please like and subscribe. Thank you for watching.